Hello everyone, you're welcome to another module of the financial accounting course, and in this lesson we will be learning about accounting fraud. We're going to be looking at what accounting fraud is, the forms of accounting fraud, ways in which accounting fraud can occur, internal controls, importance of internal controls, components of internal controls, and preventative control versus detective control. So to begin, what is accounting fraud? Accounting fraud is the intentional manipulation of financial statements to create or hide corporate transactions or create a false appearance of financial health. It can involve individuals or groups of managers, accountants, and other employees in an organization, misleading investors and shareholders, legal and regulatory authorities, and the public. A company can falsify its financial statements by overstating its revenue, not recording expenses, and misstating assets and liabilities. Another way to look at accounting fraud is misrepresenting a company's financial statements and documents, or deliberately hiding transactions, accounts, and important financial matters necessary for inclusion in financial statements. There are several forms of accounting fraud, and they include corporate fraud, occupational fraud, accounting fraud. So we'll just briefly look at them. Corporate fraud is the broad category of illegal activities carried out by a company or individuals within it. Accounting fraud falls under this umbrella. Corporate fraud also includes insider trading, bribery, money laundering, tax evasion, and other forms of financial and non-financial misconduct. Occupational fraud is done by employees for personal gain at the expense of their employers. These actions include stealing assets, payroll fraud, and reimbursing for fake or limited expenses. This type of fraud could cross with accounting fraud if financial records are manipulated, but many acts of occupational fraud don't involve financial reporting. Accounting fraud specifically refers to the act of intentionally manipulating a company's financial records. It presents a false picture of its financial health, performance, or profitability. Examples include overstating revenue, understating expenses, hiding debts and material financial events, and falsifying financial documents. Now, there are several ways in which fraud can occur, and they include financial fraud, and under that we have bill and holding schemes, channel stuffing, playing with the timing of recording revenue, recording fictitious sales. We also have unrecorded expenses. This is another type of accounting fraud that occurs when an expense or set of expenses isn't recorded. And there are several ways of doing it. It can be by deferring expenses, failing to record depreciation and asset impairments, hiding operating expenses, lowballing the cost of production. Let's look at another form, misstating assets and liabilities. Accounting fraud occurs when a company overstates its assets or understates its liabilities. For example, a company might overstate its assets and not record accrued liabilities that have been incurred but not yet paid, like unpaid wages, taxes, or interest expenses. It can also include pensions and other kinds of retirement costs for retirees. So, the next thing we'll be looking at is internal controls. And what are internal controls? Internal controls are accounting and auditing processes used by a company's financial department that ensure the integrity of financial reporting and regulatory compliance. Internal controls help companies to comply with laws and regulations and prevent fraud. They can also help improve operational efficiency by ensuring that budgets are adhered to, policies are followed, capital shortages are identified, and accurate reports are generated for leadership. Why is internal control important? Internal audits evaluate a company's internal controls, including its corporate governance and accounting processes. These internal controls can ensure compliance with laws and regulations, as well as accurate and timely financial reporting and data collection. They help to maintain operational efficiency by identifying problems and correcting lapses before they are discovered in an external audit. Internal audits play a critical role in a company's operations and corporate governance. Since the Sarbanes-Oxley Act of 2002 made managers legally responsible for the accuracy of its financial statements, it is also important to note that no two systems of internal control are identical, but many core philosophies regarding financial integrity and accounting practices have become standard management practices. While they can be expensive, properly implemented internal controls can help streamline operations and increase operational efficiency, in addition to preventing fraud. Now, we'll quickly look at the components of internal control. There are about 8 of them. We have control environment, risk assessment, monitor, information and communication, control activities, compliance with laws and regulations. So when we're talking about controlling the environment, a control environment establishes for all the employees the importance of integrity and the commitment to revealing and rooting out improprieties, including fraud. Under risk assessment, a company must regularly assess and identify the potential for or existence of risk or loss. Then, based on the findings of such assessments, added focus and levels of control might be implemented to ensure that containment of risk or to watch for risks in related area. A company must monitor its system of internal control for ongoing viability. Doing so can ensure, whether through system updates, adding employees, or necessary employee training, the continued ability of internal controls to function as needed. Under information and communication, solid information and consistent communication are important on 2 fronts. First, clarity of purpose and roles can set the stage for successful internal controls. And secondly, facilitating the understanding of and commitment to steps to take can help employees do their job most effectively. Then you have control activities, and these pertain to the processes, policies, and other courses of actions that maintain the integrity of internal controls and regulatory compliance. They involve preventative and detective activities. We also have compliance with laws and regulation. An organization's financial activity must adhere to all relevant laws, regulations, and standards. This involves keeping up to date with changes in financial regulations and implementing measures to ensure compliance. We have separation of duties as well. Distributing responsibilities among different people reduces the risk of error or inappropriate actions. This includes separating authorization, custody, and record-keeping roles to prevent fraud and errors. And finally, we have physical controls. A business must implement security measures to protect its assets, including cash, inventory, and equipment. These could involve secure storage facilities, access controls, and surveillance systems. Now we'll be looking at preventative versus detective controls. Internal controls are typically comprised of control activities such as authorization, documentation, reconciliation, security, and the separation of duties. They are broadly divided into preventative and detective activities. Preventative control activities aim to deter errors or fraud from happening in the first place and include thorough documentation and authorization practices. Separation of duties is a key part of this process. It ensures that no single individual is in a position to authorize, record, and be in the custody of a financial transaction and the resulting asset. Authorization of invoices and verification of expenses are internal controls. Now, what are detective controls? Detective controls are backed up procedures designed to catch items or events the first line of defense has missed. Here, the most important activity is reconciliation, which is used to compare data sets. Corrective action is taken upon finding material differences. Other detective controls include external audits from auditing firms and internal audits of assets, such as inventory. And this is where we'll be stopping for now. Thank you for watching this video and see you in another course. Bye for now.